Hello and welcome. For decades, investors have clung to one simple idea for safety: bonds. But today, we're going to challenge that. We're going to ask if it's time to say goodbye to bonds and find a new path forward.
So let me just kick this off with a question, and it might make you a little uncomfortable. Is that money you've so carefully tucked away in what you think are safe investments actually safe? Or could it be silently, day by day, destroying the very wealth you're trying to protect? The answer, I promise you, could change everything you think you know about investing.
Welcome to another video in our investment series. All the research and the core ideas we're going to talk about today come from the incredible work of Mr. Majid Butt. He's a fascinating guy, an accountant, a software programmer, and a deeply passionate investment researcher, and his work is the foundation for everything we're about to explore. And hey, right up front, I want to make you a promise. This isn't just going to be a bunch of theory. If you stick with me to the end of this video, you are going to get a clear, concrete 8-point action plan. It's a real roadmap you can use, so you'll definitely want to stay tuned for that. Okay, so here's how we're going to break this down. First, we'll uncover a silent killer that's eating away at your wealth. Then we'll pull back the curtain on the safe investment deception. After that, we'll talk about the real price of growth, look at the hard data, the history of returns, and get into the right mindset for success. And then we'll wrap it all up with that 8-point action plan I promised. All right, let's get into it. Our first section is all about the silent wealth killer. And I want you to think about this not as some boring economic term, but as a real, active, hidden force that is working against your financial goals every single day. And that hidden force? It's called inflation, and it has a number. For the past 60 years or so, the average annual rate of inflation has been 4.10%. Now you might hear that and think, 4%, what's the big deal? But the thing is, this force never, ever stops. It just compounds, year after year after year.
And what does that relentless compounding look like over time? Well, since 1945, the cost of pretty much everything has gone up by over 900%. No, that is not a typo. 900%. Just think about that. Your money has had to fight an incredible uphill battle just to not lose value. This chart just lays it all out so perfectly. Take a look at that black line on the right, just climbing and climbing. That's inflation. It means something that cost you $100 back in 1945 would set you back over $1,000 by 2005. And now look at the gray area on the left. That's your dollar's value. It's in a free fall. They're literally a mirror image of each other, and it's a painful reality to look at. Let's make this even more real. I love this analogy from the source material. Imagine a whole loaf of bread in 1945. By 2005, that same dollar could only buy you a single slice. Or think about that $100,000 you saved. After inflation did its work, it was transformed into just $9,563 of actual purchasing power. This is what we mean by the silent killer. It's the hurdle every single investment has to jump over before you make even 1 penny of real profit. Okay, so if inflation is the big bad enemy, where do most people run to hide their money? They go for safe investments. And that brings us right into our next section, the safe investment deception. We're going to see why those T-bills, bonds, and CDs you thought were protecting you are actually a guaranteed ticket to losing in the long run. First off, what are we even talking about here? These are called fixed income investments. Think bonds, CDs, that kind of thing. And the key word there is fixed. You get a fixed interest rate, and your principal, the money you put in, is also fixed. The problem is baked right into the design. These things are built by their very nature not to grow. This slide just breaks down the whole illusion perfectly. On the left is what we all perceive. We think, oh, my principal is protected. But the reality, your purchasing power is getting torched. We think we're getting a guaranteed return, but the reality, after you subtract that nasty 4.1% inflation, is a guaranteed loss. And the big one? You think you're taking on low risk, but over the long term, the only time frame that really matters for building wealth, you're actually taking on the biggest risk of all, the risk of going broke safely. The source material uses such a powerful analogy here. Imagine your money, your principal, is like a strong, healthy person in their prime. When you put it into one of these fixed income investments, it doesn't get stronger. It doesn't even stay the same. It's guaranteed to get weaker over time, becoming frail and old, unable to buy what it used to. It's a slow, predictable decay. So if staying fixed is a trap, what's the answer? Well, that leads us right into section 3, the price of real growth. And this means we have to embrace a concept that, frankly, scares the heck out of a lot of people: the bouncing principle. So, what on earth is a bouncing principle? It's just a simple way of describing the natural ups and downs in the value of something, like stocks. It's that volatility we see on the news. But here's the absolute key to everything: that bouncing, that volatility, it's not a bug. It's not a flaw in the system. It's the price of admission. It's the cost you have to pay to get access to much, much higher long-term returns. This quote just nails it. The amazing returns you see from stocks over the long haul aren't some kind of magic. They are, quite literally, a payment. The market is paying you for your willingness to tolerate those short-term bounces. You are being compensated for your patience, for not panicking. It's a reward for discipline. Okay, but talk is cheap, right? Let's get to the proof. Let's look at the hard data. This section is so important: a history of returns. We're about to see the irrefutable evidence that proves why putting up with that bounce has been the best financial decision you could possibly make over the long term. This chart right here is one of the most powerful images in all of finance. It tracks what happened to a single dollar invested back in 1925. Look down at the bottom lines. That gray area is inflation, our enemy. The line just crawling above it, those are T-bills, our safe investment. See how it barely keeps its nose above water? Now, look up. Look at the lines for stocks. That $1 in small stocks grew to over $10,000. It's not just a little better, it's a completely different universe. That's the power of owning businesses versus just lending your money out. Now, you might be thinking, well, sure, that chart probably just caught a lucky run. But it didn't. The consistency is just mind-blowing. If you look at every single 20-year period since 1926, we're talking through the Great Depression, World War II, the crazy inflation of the 70s, the dot-com bubble, through all of that chaos, stocks beat bonds in 58 out of 59 of those periods. That isn't luck. That is a fundamental truth about how markets work. And if you need one more piece of evidence, here's the final nail in the coffin for the bonds are safe myth. This chart shows the volatility, the bounce, for both stocks and bonds. Look what happens around 1978. That's when the Fed changed the rules. Before that, yeah, bonds were pretty calm. But after, whoa, bond volatility shot up to the point where they became almost as jumpy as stocks. So now bond investors are taking on all this extra risk, almost stock-like risk, for the same old pathetic bond-like returns. The deal has gone completely sour. Look, knowing all this data is one thing, but actually acting on it, well, that's a whole different ballgame. It takes a different mindset. And that brings us to this critical section, the investor's mindset. Because at the end of the day, having the right emotional discipline is way more important than just knowing the numbers. Let's look at a real-world example, the banking crisis back in 1990. The mood was just pure panic. Real estate loans were blowing up left and right, people were pulling their money out of banks, Congress was making threatening noises, and every analyst on Wall Street was slapping a sell rating on bank stocks. The story that everyone, and I mean everyone, believed was that banks were done for. It was over. Okay, now look at what actually happened. You see point A on this chart? That is the moment of absolute maximum fear. It's the point where it felt like the sky was falling for the entire banking industry. And what happened immediately after? It kicked off one of the single greatest multi-year runs for bank stocks in modern history. The point of maximum fear turned out to be the point of maximum opportunity. The people who sold in a panic, they lost big. The people who held on, they were rewarded beyond their wildest dreams. So what's the big takeaway here? It's this. This is the ultimate test of a good investment for you. Can you stomach the paper losses? And even more important, when the price drops, does it actually become more attractive to you? If you see a 20% drop and your first instinct is, great, it's on sale, I should buy more, not, oh my gosh, I have to sell, then you truly understand what you own. You have the mindset of a winner. And that brings us right to the part I've been promising you. We've taken apart the old myths, we've looked at the data, we've talked about the right mindset. Now it's time to put it all together. Here it is, your 8-point action plan. Okay, point number 1. The first step in investing is to understand the environment, and the environment always includes inflation. This is square one. It's the starting line. You simply cannot build a winning strategy if you don't first acknowledge this constant grinding force that's working against you. Inflation is the hurdle you have to clear just to get to zero. All right, number 2. Over any extended period, prices rise and the value of a dollar declines. The inflation bill never arrives in the mail. This is exactly what makes inflation so sneaky. It's silent, it's invisible. You don't get a bill at the end of the month that says, hey, you lost 0.3% of your purchasing power. It just happens. And it's so easy to ignore until decades later, you realize your nest egg can't buy nearly what you thought it would.
Point number 3. Safe investments such as T-bills, bonds, CDs, and money market funds are poor investments because what they give is less than inflation takes away. This is the core truth of this entire video. These aren't really investments in the sense of growing your wealth. They're more like savings accounts that have a guaranteed leak. You pour your money in the top, and inflation is right there poking holes in the bottom, draining away your future.
Next up, number 4. History has shown that stocks are the right investment for an environment that includes inflation. Reason supports the historical record, since an investment in a business is an investment in something that grows. This explains why it works. Stocks aren't just little blips on a screen. They represent ownership in actual living, breathing businesses. And what do businesses do? They innovate, they sell things, they raise their prices to keep up with costs. They are designed to grow, which makes them the natural enemy of inflation.
Point number 5. Part of the price of having an investment that succeeds in our world is that it will fluctuate. We need to learn to tolerate the fluctuations. Investments will tend to fluctuate. This takes us right back to our bouncing principle. That volatility isn't a sign that something is wrong. It's the admission fee you pay to get into the theme park where the best rides are. You have to accept the bounce if you want the long-term growth. There's just no way around it. Number 6. The true long-term investor will accept these fluctuations and decide just how much bouncing principle is emotionally acceptable. This is all about knowing yourself. This isn't a one-size-fits-all game. The goal isn't just to maximize your return, it's to find a strategy that you can stick with, one that lets you sleep peacefully at night, even when the market is going crazy. Moving on to number 7. Conservative investors will seek investments that have an acceptable level of fluctuations and are easy to hold or buy more of during periods of decline. This is the practical lesson from that 1990 banking story. The goal is to own things you understand so well and believe in so deeply that when the price drops, you see it as a sale, not a fire. Your conviction is your shield against fear. And finally, the 8th and final point. Your emotional relation, or better yet, your lack of emotional relation to your investment will make all the difference between good and bad decisions. This might be the most important rule of all. Ultimately, your success doesn't come down to picking the perfect stock. It comes down to mastering your own emotions. Building a calm, rational, and systematic approach based on these principles is what truly separates the winners from the losers. So let's end right back where we started, with one last question for you. Now that you've seen the real data, now that you understand the real definition of risk, what are you going to choose to fear more? The short-term, often temporary bounce of the market, or the permanent, silent, and totally guaranteed bite of inflation? The choice, as always, is yours. Thanks so much for watching.